Alright, so gang, it's your boy Nature, aka Nature. You already know what time it is, man. Alright, so today's video we're gonna talk more and more about, trading. We gotta still go over the definitions. There's a lot of information that we still haven't gone over. We're only like about a good 10 to 20% in. We still have a lot of information that we need to know information is everything. So it's the information that we need to know. So, you guys can make the most out of your trades and make the most money out of all your trades and profit. So that's what we're going to do. We're going to still go over all the definitions. And then eventually we're going to put it all together. I'm going to show you guys what to do on the charts. But it's also important that we understand the information so you guys know what you're doing. And, you just don't hop on a live account because you feel like you know what you're doing because you've been on a demo account or, you've just been trading for a while and you feel like you know what you're doing. I know there's still a lot of information that you don't know. And, from my experience, from losing my account, because you're going to probably blow your account that way. I don't want to jinx you, but most likely you're going to blow your account that way. So, I'm not going to avoid those mistakes that, I've been through and my mentor told me and he's been through. I'm just going to, get right into it and help y'all avoid those mistakes. So you can make as much money in this, in this market. So, all right, so this game, let's start. So we're talking about a bounce. Okay, so what is a bounce? From my experience, a bounce is, is is when you wait for price to tilt, in your favor, and it bounces off of some type of support or resistance. Okay, well, I'm gonna also read the definition. We're also gonna read it, but it bounces off of your support or resistance. And when it does that, instead of just buying off when price breaks, when prices just breaks through, we simply buy and we sell right. We don't sell right off the bat. Okay, this is for conservative traders. I went over conservative and aggressive traders already in the OnlyFans. So this is for more conservative traders that we simply don't just buy and sell right off the bat. We wait for price to bounce, before we enter. By doing this, we avoid the moments where price moves so fast that it slices through support and resistance levels like a knife slicing through some butter. And which one is going to explain that is called a break. But instead of doing that, instead of just bouncing off the break, because you also just getting right in off the bat when you see prices moving in, it's better to wait because price will always, bounce back to the price area that it was originally at before going back in that direction. So, it's important that, a lot of traders will just wait for the bounce or the pullback. A lot of traders, even I, sometimes will just wait for the bounce and the pullback before we get in, to avoid those moments when price is just moving so fast. And it could be moving so fast and you're thinking you're waiting for the price to bounce back and it's just moving so fast it doesn't bounce back. Sometimes that doesn't happen. Sometimes you don't get bounce back in the market, and I'm going to be explaining all of that. So alright, so let's just start. So this is the strategy that allows you to spend less time looking at your chart and more time doing whatever you want to do. Of course, this is the basic premise of the strategy that you enter the trade as the trend on a higher time frame is turning around. So to avoid a lot of these mistakes, they look on a higher time frame. So you look on a day chart, you look on a weekly and the 4 hours. You look on a higher time frame to see what price is really doing, what the market is really doing. And then the pullback strategy. All right, to identify like the pullback strategy, you would just you would go on a higher time frame to see what price is really doing. On a higher time frame, price could be in an uptrend on a higher time frame. I'm gonna show y'all that, and it will just pull back, you'll see a bounce back. So that's but we look at you have to look on a higher time frame. So that's just a few definitions on how the pullback works and price works. Just find the video that I was looking at. See, let's go to this one first. I think this is the one that I was on. Is this the one I was on? Let me just make sure this is the exact one. Just reading. I do a lot of reading. Not the one. I don't want you to get you confused. I want to get this definition straight out. Investopedia. I think it was this one. Talking about the pullback. Yeah. Alright, so let's get it. Alright, so Forex stands for foreign exchange. So in foreign exchange is when, a rise and a fall against currency pairs, two currency pairs, and off those two major currency pairs, such as the US dollar and the euro, which is the most currency pair to use in Forex is the US dollar, the euro over the US dollar. So those are two currency pairs. So the Forex exchange, Forex is foreign exchange in two major currency pairs, and you trade against the rise and falls against those two major currency pairs. And if the U.S. dollar is rising against the euro, then you will buy. And if you feel like the euro is rising against the U.S. dollar, you will sell, and vice versa. So traders are looking for quick profits in this first moving market can make use of the bounce strategy. So the bounce strategy is usually used on a short period price chart, which is true. The traders set a moving average line, and you just use the traders set up the EMA, which we already went over moving averages. And I'm gonna show y'all examples of that too, and like the later examples. But we're just gonna get definitions, and I'm gonna put it all together. So the plays, the bounce off, the moving average. So you usually trade using a short period price chart. We usually trade the bounce back on short periods, the price charts. The traders set a moving average depending on what trend you can trade. You can trade the bounce back strategy on an uptrend and a downtrend. It plays a bounce using a short period price chart. The traders set a moving average line and plays the bounce off that line. So when the currency pair reaches this technique, which can also apply to day traders and stocks, require carefully and consistent attention to the market and activity during this trading period on a bounce back. So it's short term trade. You gotta pay close attention when you use the bounce back strategy, because it's usually used on a 15 or 5-minute chart, which your forex market the broker's active account active. I would prefer that you try this on a demo account before you actually try your live money. With your forex broker's account active, select a short period price chart of the currency pair that you're trading. The short period price chart will be considered a 15 or 5-minute chart. Works well with the bounce strategy, which is designed for short-term trading, which you can open and close a position within an hour. About 45 minutes to an hour, 30 minutes. Often quite, a bit faster. It's more like a scraping strategy, because you only use the scraping strategy, which we're going to also go over that too. Scraping strategy, intraday trading strategy, and swing trading. We got day trading strategy. We got long term like swing in a day, and you have the scraping strategy, which is usually for like the 15 to 5-minute charts. We use the 15 to 5-minute charts also to get sniper entries, which I'm going to be showing you guys. So this is designed for a short-term trading, which you open and close a position within an hour, and often quite a bit faster than that. The bounce strategy can work whether a currency pair is trending higher or lower in the forex market, whereas the uptrend and downtrend, this bounce strategy works. In the forex market, traders can either buy and go long or sell and go short on on the individual pairs on each pair. So as far as the moving average, how you trade on the bounce back, as far as using moving average, our EMA moving averages that that our mentors showed us that I was told was 8 and 14, and I showed that y'all in the EMA moving average video. So displays and exponential moving averages, the EMA exponential moving average that we know about is measured in average closing price of the currency pair over the last 25 to 50 trading periods. It's closer, it's more accurate. That's why everybody uses the EMA moving average. And I told you our moving averages for trading periods more closer. It's more about 8, 10, 14 trading periods, not 25 to 50. It's a little still kind of long. We want to know that for 25 and 50 was going on in the last 25, 50 trading periods. We want it closer. We want it to be like we want to know what's going on in that last 8 to 10 to 14 trading periods. So that's why we use 8 to 10 to 14 trading periods, because it's closer to price and what's going on in the currency pairs. So your online broker should provide this basic technical indicators through your pull down menu or similar devices, and I'll show y'all how to use the EMA period and how it works on your charts. I displayed that already for y'all. It has displays on your charts, and you can change the color across. You can change the color, so that's easy to compare with the price indicators. Varieties of price strategies used for multiple EMAs. There are varieties of most price strategies. Bounce strategies used with multiple EMAs. Cannot combination, and or combining, or requires that you confirm on a long-term trend. Though we require that you look on a long-term trend to see what's actually going on, because this is more for my advanced sessions, but on a long-term trend is what's really going on. Okay, and on the 5-10 minutes charts, we usually look that in for like entries, for like sniper entries. Yeah, for the pullback strategy, so we can know when to get back in for a sniper entry. So we'll scroll down to the 5 to 15 minute chart to see what's really going on. But you really gotta look at the long term trend, because for the long term trend on the day chart, the weekly chart could be going up. And on the 5-10 minute, 15 minute chart, it could be going down. That's just the pullback. That's just the bounce back, the bounce strategy. Market has to bounce back, and we look on a daily and a weekly chart to see what's going on for the whole week and that whole day. But to actually scroll in, you have to go to the 15 minute chart, 30-minute chart, 2 hour, really 5, 15, to see what's going on long term. Okay, with the bounce strategy is based on a theory that a sharp trend in price will eventually retrace to the moving average. So you're waiting for price to retrace back to the moving average, then bounce off that average and resume in previous moves. So once it bounces off the moving average, then you're waiting for it to go back in direction. Once it bounces off, it'll go back in direction. In the currency market, bounce strategy works because many active traders are taking their clues from the EMA indicator, the moving average indicator, also with their trend lines, any type of indicator, technical indicators that they're using. They also could be using no fundamental market news to consider it, or they also could be using the marketing news to consider what's going on. So as far as the uptrend, how you trade on the bounce, if the price of the pair is trending up and it's fluctuating, and if the price of the pair is trending up, if the uptrend is trending up, price is trending up, and it's fluctuating and moving, and it's fluctuating above its moving average, buy the pair after it bounces off the moving average. The price will trend up, and then it will fluctuate, meaning it'll start to off the moving average. It'll start to consolidate. Once it starts to consolidate, buy the pair after it bounces off the moving average. So once price will consolidate, go back down, it'll start to retest. The market will start to retest. Every day around 5 o'clock, it retests. That's when the market closes. So when price does retest, you want to get in after price retests. a bounce back. Okay. So off the moving average too. So when price falls below the EMA line, when price falls below the EMA line, which is the moving average, um, and it's going down or going up, depending on the trend. If it's an uptrend, it's going to go down. It's going to bounce. It's going to bounce down. It's going to if you're on a downtrend, it's going to bounce up. So when price is down and it hits below, like it looks like on a downtrend, set a limit on a buy order. You also have to look. This is a good way to actually kind of like find sniper entries. Um, you want to set a buy order just above that line. So what I mean by a buy order is that price will go down and then price will go back up. A buy order allows you, this more for like our advanced sessions. But, I'm gonna go over this. Again. But a limit buy order is a buy order where you can put a buy order in, for the limit price that you want it to go to. You don't even have to watch it. This allows you to have free time, do what you want to do. You just have to set a limit buy order just above that line. Just above the line, just below above the EMA line. Once it's going down, you set a buy order, and the buy order you set it there, and you're saying that once the order fills up and it does, and once price starts to go back up, your buy order that you put it in, you don't have to do nothing. It'll automatically just put a buy order in for you because you set up a buy order. But you have to set this up. I'm going to teach y'all that too. Like I said, it's more advanced, but it goes hand in hand. They're talking about it right now. You have to set a buy order in where you think it's going to go at, and once the price, after it stalls, after the order fills, and it does, if it does ride the pair up until price stalls. Once price stalls, then you want to put a buy order in, as when price starts to go back up, and as soon as price goes back up, your order will go in, and it's called a buy order. And then you want to just ride that. You want to ride that all the way up until you see price start to stall. What they say right here, ride the pair up until price stalls. Once price stalls, stall means it starts to retest. It starts to make choppy, which is a sideways trend. It starts consolidating. It's just going sideways, which is a sideways trend. Then you want to either want to exit the trade because you made a profit. You made as much profit as you can, or you want to wait. That's if you're day trading. Sometimes that's if you're scraping. If your entry, if you're week, if you're like swing trading, for like more than a day, or more than for like a few days or a week, then you might actually leave it in. Especially you looking at the overall trend, 4 hour a day chart, the weekly chart is going up, for the whole week, for the whole month. Then I do this too. Some of my traders, this is more like advanced. We do this too. We'll keep that in there. We'll keep that trade in there, because ultimately we know, looking at the 4 hour, the daily, that it's still going up. It's going to continue going up, and to maximize our profit and maximize the amount of pips that we get, we'll just stay in that trade. And that's more called swing trading. We're going to talk more about that in a little bit later on. All right, so I just want y'all to understand that though right now, get familiar with that. So in this case though, you will, once it starts to sell, price, when you ride the pair up until price sells, then you will close out by entering a sell trade. Okay, trade trends, starting to making a new trend, starting to make a downtrend. It's no longer going up. Prices won't go up, they'll go up and down. So now it's a new trend. So now you want to enter for sell trades. So then you set your stop above 20 pips below the entry point of that sell trade, and you ride that down. Until it does the same exact thing. Okay, as far as the downtrend. You're looking to take small profits in the bounce, now hold the trade open for large gains. Like I said, this is more for scrapers. If you're looking to make some profits during the bounce on the bounce back for like the next 45 to an hour, you might be in that trade. That's like more scrapers, and they just constantly do that throughout the day until about 5 o'clock. Um, so this is more like for like you know small profits that that you keep doing over and over, which is going to do a bunch of small profits throughout the day, and it makes a large gain. You're not going to hold the trade more like a day trader when you hold the trade for the whole day, and you let the trade do what it does, and then once 5 o'clock ends, then you exit out of that trade. This is more like this example about trade strategy is more for um, long short term traders. So same thing though as far as the downtrend. If your pair is trading down, hovering below the moving average, if the pair is trading down, right, it's going on the downtrend, and you start seeing it hovering below the moving average, you will put a short pair in when it rises to the EMA, because you have to wait. You have to wait for it to bounce back, even though it's going on a downtrend. You have to wait for it to bounce back for you bounce back strategy on the downtrend. So you will wait for that EMA to rise up, your or price to rise up, and then once price rise up, then once price rise up, you put an EMA, you set in a limit sell order, because price is going to rise up on a downtrend. It's going to rise up, and then it's going to go back down. So you want to place your price once price rises above your EMA and then pulls back before going back down. Then you can put a sell limit order in. The sell limit order, like I said, a buy limit order, sell limit order is when you put a order in, a sell order in, a limit sell order that you put in. So you don't have, and if you just put it in, you already know what's going on. You already know that it's going to go back down. You already looked at fundamental news. You already looked at the news, and everybody, tradingview.com, everybody's saying that it's about to go back down. And you look on the 4 hour and weekly chart, and it's about to go back down. It's just overall, it's going down. It just made a pullback. This is how traders trade on a pullback strategy. They wait for it to pull back before getting in the market. With a sell limit order, it allows you to just put a sell limit order, and whenever price goes down, it's going to hit your sell limit order. Once it hits your sell limit order, it goes down. Your sell order is activated, and you don't have to do nothing. The only thing you have to do is, I'm going to teach you how to do that too. It's like I said, it's more advanced, but it goes hand in hand right now. Or you can just watch the market, and you can watch the market the whole time. And if you have time in your hand, you can just watch the market the whole time. You can watch it during the pullback and all that. And you don't have to put a sell limit order in. And you can just watch it do what it does. But if you just want to put a sell order in just below the line, where you think it's going to drop, and where price is going to continue down. And when the pair does move down and resume it in the dominant trend, your order will fill in, and you will ride that move until it stalls. You'll do the same thing. You'll ride that move. You'll ride that trade all the way until it starts to stall. It starts consolidating, starts making them sideways trends, and then you will close the trade manually, or you'll close the trade. You'll exit out of the trade, and you'll put a buy order in. The difference between a limit sell order and a limit buy order is that you're actually putting in a limited sell order and buy order for this price. And when price hits this time, that limit order or that buy order, that sell order will go in, and without you doing nothing. And this is just based off of this like more advanced session. But when the difference between a buy order and a sell order is just you just buying an order manually and selling the order manually. Everybody knows how to do that. So this is, like I said, it's more advanced, but it goes hand in hand. Like I said, I'm gonna give y'all all this anyhow for free. I mean, as much as I can anyhow. So, but that's how that goes. So then your order will fill. Once your order fills in, that sell order fills in. So it's already it sells in. So you put a sell limit order in, then you will just trade that in. You will ride that move all the way and down until it starts to sell, starts making sideways trends, starts retesting, and then once it starts to retest, you know, you want to look close attention to the next previous candlestick, the next previous, structures makes a higher high, a higher low, for a buy order. And like I said, we're gonna go all through this. I got a lot of content I'm giving y'all. It's just the beginning, so but you would just put a buy order in. Once you start seeing it start to sell, it's not moving as much. That's when you want to start to look in for buy orders because it might be going. The end of that downtrend, might be done, and the market is constantly moving, so it might just be a buy now. Now we're looking for buys. We're now looking at the 5 minute of higher highs, higher lows, looking for buys. So you want to pick your stop loss. About 20 pips. 20 when you're looking for a buy. You want to pick your stop loss about 20 pips below the entry because price will 20 pips because price will bounce back before it'll go up and down before it actually goes in a new trend and in your direction. So that's why they say put your stop loss a little below 20 pips below the entry price, so you'll be able to last throughout the trade. Don't over leverage your account. Don't that's more advanced sessions. You don't want to over leverage your account during this time. So you can last. The price will. That's why I say 20 pips above the entry price because the price will go up and down before. So you don't want to risk too much of your real money. You know what I'm saying? If you're doing this for real money, you don't want to risk too much of that. So it's better that you I say risk management is important when it comes to not over leveraging your account during this. So you will blow your account and you'll be mad that you missed out for the whole week on a trade when you could have just not risk so much of your leverage or so much of your money. So the price will go up and down. So never keep your position open. We don't keep it open for too long. I might even keep it open for a day or two or for the whole day. But eventually you close, you take your profit, and we look for price and see what price wants to do next. So never keep your position open if you're ending your session, whether you're long or short term trading. The idea is this is for a short term gain. So this bounce back strategy is for short term gains, which you can repeat every time price hits that EMA. Every time price bounce back, you can repeat this strategy. So don't use the bounce strategy at the market opening when announcements or news. The price tends to move, and the price is unpredictable in an unpredictable way. Also, don't move it any around the EMA. It's just consolidating. It's not making no trend. No trend is present. It's just going sideways. Don't use this strategy. Always consider the dominant trend. So always look at the 4 hour and the weekly to see what's going on. So always consider the dominant trend as shown. And also look at the 15-minute chart too. Because the 15-minute chart is generally just the direction of a pair over the last 24 hours. Okay, because 24 hours is a day. So every 15 minutes is you look at the chart. It's going to show you what's going on in the last 24 hours just in a 15-minute chart. So always trade using stop loss orders, sell orders, buy orders, and don't risk more than 2 or 3% of your capital on any single trade. Okay, do not overrisk your account on any of these trades. Okay, that's the fast way you can lose your money. So that's for the bounce strategy. More about the bounce. Next, we're going to go over the break strategy. So yeah, we have to understand the fundamentals. This is all technical analysts. Just understanding the fundamentals of what's actually going on in the market, so you know what you're doing. So what is a buy bounce? A buy bounce strategy that focuses on buying a given security once price hits the active fall towards the important level of support. So the price will always, hit the support and resistance level before dividing and going back in the trend that it wants to go. So this is very important. Once it hits the level, it hits your support level, traders will buy or buy off the bounce and attempt to profit from a short term correction or a bounce back off the identified support levels. I'm gonna show y'all all this in the market and in the later videos. I'm gonna show y'all how to actually put this all together. So understand strategy are typically identified by typical analyst patterns. There are numerous patterns that can be used to various trading strategies that also can be deployed to profit from a buy bounce strategy. You can use the trend lines, you can use Fibonacci, you can use all these different strategies that you can use to make profit off of this buy bounce strategy. So when a security falls to a support level, it usually falls to a support level, bounce back off a support level, or a resistance level. A trader may purchase a position and anticipate a near-term bounce. So once it pulls the bounce back, then you can purchase in off of that bounce back. So technical patterns, many technical analysts, they use there's a lot of different technical analyst indicators that you can use. You can use the Envelope channel, the Boiler Band, it's a moving average over the last 50 to 200 days. Same thing here. For a high and low price, over time frame, these different moving analysts. You don't really need the EMA, moving average. You ask me, trend lines, Fibonacci. So buy off the bounce trading strategy. I'll show y'all how to use Fibonacci off the buy bounce trading strategy. So a buy bounce trading opportunity on a security reaches a support trade line. So when it hits the support trade line, it'll bounce back. So it'll bounce off the last area. Remember, support is the floor, and resistance is the ceiling. Okay, so support is the floor, and resistance is the ceiling. So security will generally trade within a specific price channel range with an extended period of time, with a security price fluctuating within resistance and support price ranges. So once price does, security will generally trade within a specific price channel range. It will go to this period of time before fluctuating in the actual position that wants to go back in. So it'll fluctuate off the resistance and support areas before actually going back in that direction. So it will bounce back off of resistance support before actually going back in that direction. When a security price reaches a support line, traders can potentially use a buy bounce strategy to profit from an expected increase off a low support level. So most traders want to confirm a bounce off a support level by using combinations of quantity and quantities technical indicators before entering a position. So for example of a buy bounce order, let's say that your analysts say that XYZ stock will bounce off of 40 area, off of historical stocks and how it trades and ranged off of 40 and 50 before. So as the stock approaches the 40 limit, you put in a buy order, which I told y'all how to put in a buy order, and I'm gonna show y'all that again, to own a share at 40. So once it hits 40, it bounces off to 40 because it did that. It price bounce. It's called price. We also have to go over to it's called price. It's called price action. So we have to understand how price action works and how price bounces off of these actions off of certain points where price bounces off of before going back up or going back down in your direction. So once price hits the 40 range, because historically it hits the 40 range, 50 range multiple times throughout history. So once it hits this 40 mark, it bounces off that 40 mark. Okay, we know that it bounced off the 40 mark, is going back up once it hits the 40 mark. So your goal is to profit from a quick bounce, and a stop from the support area will be 40. So the most basic trade will include buying in shares of security to profit from a price increase. So traders can also use options to see potential profits in scenarios. Investors will want to buy and own their money and call that expected created profit as a price rises. As price rises, the investors can exercise the call option at the strike price below the current price and benefit from the difference. So once price does, strike back down or makes that pullback, then you can you can benefit from that. Okay, so that's basically everything about using the balance strategy. All right, gang. So I hope that helped.